Hi, this is Randy Finney with the right side of the chart, and today is Friday, October 21st, 2016. Wanted to do a quick overview on the broad markets, look at a couple key support levels, key levels to watch, and take a look at this. We'll start out with this chart. This is something I've posted in the past many times over the years, and it's something I refer to as the OpEx ramp. So what that means is OpEx stands for options expiration, and there are different options expire on different dates, but standard options expiration is the third Friday of every month, so that would be today, Friday, October 21st. And what the chart shows here, this is a 2-year chart of the QQQ going back, 2 years. Each of these red vertical lines shows you option expiration dates. So this is just a year break mark here at 2014. And again, the red lines are the standard options expiration, so the third Friday of every month. And what there has been a clear tendency over the years to see what I refer to as an OpEx ramp, meaning they ramp prices up typically into the options expiration date, followed by a sell-off or correction. Like I always say, there's nothing 100% in trading, so there's a few instances here where that didn't work. But if you take a look, the common theme has usually been to see just a few days of trading, typically less than a week. Maybe 5 candlesticks. These are daily candlesticks, so 5 trading sessions on average at most. And you then see a pretty clear trend of that OpEx ramp being faded and then some. In other words, a correction right after OpEx. So there's one. You can see the white arrows here. And I made some notes that when you have a sell-off just before OpEx. So in other words, this first one here, there's the ramp. You did have a correction, but then you had a ramp right back up almost to where we started. And so then you had the OpEx fade. However, in this case, we didn't have an OpEx ramp. They sold the Qs down into options expiration. So therefore, you didn't have the typical fade because there was no rally to fade. You already had a correction. You already alleviated any near-term overbought conditions. So again, a few instances. They're marked here by the, well, in this case, it shows you here, but these are some of the other ones here where you had a ramp up into options expiration, so therefore you never had the fade. So that's what the white circles there represent. So there it is, a clear trend. You can screenshot this chart or stop the video, take a look at it, and again, it's pretty clear that right on. In some cases, this one happened to peak right on options expiration. If you look at the candlestick right there, there it is, and a very powerful move down, another move down. And this one, you can also look at these white arrows here. I'm sorry, the circles, the shaded areas, they came on the heels of these very big corrections here. And so there's another reason. Plus, as I said, you had a ramp up into OpEx there, so therefore you never had the fade. You had a very strong drop here. I excluded this one. You had a point, and you also sold down. You didn't have a ramp up. You sold. It started to ramp, but the last 2 days faded every bit of that ramp. So again, I've studied this in depth, and the pattern seems to be very, very consistent. And the few times that you don't have a pretty significant correction, either immediately or within a week or so after options expiration, has been when you've had a very large correction or even a drop leading right up into there. So in this one, you can see here back in that's April, options expiration in April. There's your sell-off, and we never had a ramp. Prices closed right about where they did during the sell-off. At the bottom of the sell-off afterwards, so then you had a rally. And this one actually did roll over. You ramped up right after OpEx and you rolled back over. Now, let's just take a look, fast forward to today. So here was the last, this was back in, what is that, August. There's August expiration. You certainly had the markets peak there. They dropped down, they went back up. So in most cases, if you take a look at this chart or replicate this on your own, you could even short, more often than not, if you just shorted the Qs right after option expiration, you never really got underwater. Even though this one took a few weeks to play out, you dipped, you came back up about to where you shorted, about where the highs were right after the day after options expiration. Then it had the sharp drop. and you ramped up into OPEX, but following a sharp drop. So this period here, and we've been in this choppy trading range, we haven't really had a ramp or much of a drop, because you can see here we've opened about or we're poised to close. I'm doing this video again before the market opens today, so let's see where we close. But so far there has been, I'll draw it out here, a little bit of a ramp. We've traded mostly sideways throughout this month. And so far from the last few days, there's been a little bit of a ramp, but we're stalling at that key 118 level that I've mentioned on the Qs ever since we broke above it. I should say down below it. So point being that we didn't have much of a drop, and in fact the drop that we did have, we rallied back most of that. So my expectation would be that this pattern, all these white dots, white dotted arrows, remain in play, and more than likely that favors, sometime next week, by the end of next week, a substantial correction kicking in. Okay, let's just look at a few key levels that I'm watching. This is the QQQ. I posted in the trading room yesterday what I call a flashpoint, or a very key support level on the Qs. A few days ago, earlier this week, if you check on the site, I posted some levels as well. I call them flashpoints, and I used the NASDAQ composite. Might have used the NASDAQ 100, NDX, S&P 500, a couple other indices. But a lot of you trade the Qs. If you're not a E-mini futures trader trading the NQ E-minis, you're probably trading the QQQ or some derivative thereof, such as SQQQ, TQQQ, or etc. So this is a level to watch, and I like the 115.75. If you zoom in closely here, you see there's really two close lines, parallel lines. That's what I call a support zone. 115.75 is at the bottom. The 115.75 happens to be, if you look here back, that was the high in 2015. So this candle I'm grabbing, you look at the crosshairs, it's telling you that little pop-up box says the high was 115.75, and look how important that level was since then. So there's a high in 2015. We came up. This is just an erroneous print there, that long candlestick wick, or that wick, or shadow it's also called. But the body, we closed there. We failed again. We came up, hit that level again, failed. Came up, hit it again, closed, failed to get above it. So that was 4 days of trading where we tried to get above it. Finally, we gapped above it, which is typical, to gap above resistance. So now broken resistance becomes support. This was a breakout. This was a breakout to new highs in the Qs, which is a leading index. Came back up, and as expected, I mentioned at the time, typically these kind of breakouts, especially because of the technicals weren't very strong, we didn't really base there. There were other indicators that we probably wouldn't just blast off to the moon from there. And so we did. We came back and we back tested. So again, look at how many reactions. We back tested 2 days in a row. Finally, we gapped down. Now, this was a fake down move, or a fake. Sorry, actually, I accidentally hit the pause button there. So a false breakout. And you have this couple days of action, but we whipped right back up in there, got right back above that level. But again, it has acted as a very support and resistance level, going back all the way to 2015. And then most recently, we came back and tested it again, the top of that support range. So from my experience, when you have a breakout like this, you've already come back, you back tested the breakout once, you did it again, you failed, but you got right back up in there, then you came back a third time, especially after this what I call bear trap or false breakdown. The Qs really should have blasted off if there were a lot of buyers in this market, and they didn't. But more importantly, the battle's not won or lost yet. However, a break below that 115.75 level, I think, will certainly, or more than likely, open a waterfall sell-off. You'll also get confirmation, as I said, one of the more reliable trend indicators, very simple, is watching the 9 EMA, the second of these two lines to cross, which would be the white line here. That typically, puts the intermediate term trend on bearish. Once that happens, you can see back here, this point, you had a bearish trend, you had a bearish trend back here, and throughout most of the last 7 years, really, you'll see, if you go back 7 years, we're only going back a couple of years on this chart, you'll see that the 9 EMA was above the zero line, and the trend was bullish. So there's something I'm looking for. Very steep divergence. We had the breakdown below this rising wedge, not just on the Qs. Every U.S. stock index out there has broken down below their uptrend lines. So that in itself is a sell signal. Now we're just waiting for the next thrust down. Usually after breakdown, at some point you get initial reaction, and that seems to be what this is. So again, the battle's not won or lost yet by either the bulls or the bears. This is sort of a stalemate. So we've traded sideways for the last 3 months, but that's a level that I'm watching on the Qs. Comparable levels on the SPY, the S&P 500 have a resistance or support zone that runs between 211 and 212.20. So 211 is what I would call my flash point. That's a pretty key level. The similar story. The SPYs broke out to new highs recently. Couldn't hold those new highs. Came back in and back tested. We went a little bit above there, but as you can see, these lines that I have, they're there for a reason. There's a lot of reactions when you look to the to the left of prices. You see reactions, whether they're candlestick bodies and or shadows. Quite a few there. So 212.20 is a level to watch. We just recently broke it intraday, but we snapped back up and closed above it. As I often say, intraday breaks of support or resistance on a daily, when you're trading off the daily time frames, aren't really significant. If you take those, then there's a good chance you're going to take a false signal. So that's why it's preferable to wait for a candlestick close, a daily close below those levels, or a very impulsive break. In other words, if we take down 211, take out 211, which I suspect the way it'll happen, it'll be on a very impulsive move down through there. And most importantly, always trade the indexes. Even if you're just trading the SPY or just trading the Q, never trade those in a vacuum. Always look at the other indexes. So what I mean by that is we need to see the Qs break below that flash point as well as SPY to really confirm. And if you can see the mid caps doing it, the Dow, Wilshire, all the other major indexes, that just helps to put the odds in your favor for a nice short entry, which could be a multi-month swing short trade. So those are the levels I'm watching. And again, looking at options expiration today, and we'll have to see if the pattern repeats next week of prices moving lower after options expiration. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.